Well, hello and good morning, everybody, and welcome today to the BMT Tax Depreciation webinar for property professionals on tax depreciation. My name's Brad Beer. I'm the CEO of BMT. 25 and a half years I've been with BMT doing lots of depreciation schedules, and met many of you along the way, which has been great through this industry. What I'm going to do today, we've got about 45 minutes, maybe a bit less, allows a bit of time for questions if that happens, is I'm going to go through and do some basics on depreciation, what it's about, what difference it makes to investors, which are your clients. You're selling or you're managing property for people. They're in there to make money and maximise those returns from those properties. We make a pretty big difference to that doing a depreciation schedule. I'm going to show you how, but then really try to make it simple and go, how do I use this as a property professional to make myself look smarter, better, make your clients happy, and getting the best returns they can from investment properties that they do buy. BMT has been around 26 and a half years, of 25 and a half of them, those that I've been here, and we're about 190 to 200 staff spread all over the country. We've done 900 and something thousand on depreciation schedules, so we've seen most properties and things over time, or types of properties. So let's get into it. What is it? Wear and tear. What depreciation is wear and tear on items, and the tax office allows us to make a deduction as a property investor for the wear and tear on those items. We kind of understand it pretty well when we talk about our cars. We buy them, you drive them out, they depreciate or go down in value pretty quickly, and they're worth less. It kind of works the same with your property. Well, the building itself. We buy property hoping for it to appreciate or go up in value, which it does, but the things inside do wear out over time. So we get to claim a deduction related to that wear and tear. The carpet wears out, the bricks wear out eventually, the stove wears out and breaks down over time. These things we get to claim a deduction, a non-cash tax deduction against that wear and tear over time, similar to the car, but we actually get to make some claims for it, which we do as the car, and hopefully the value of the actual property goes up over that time. Why does a quantity surveyor get involved with that? So we're not an accountant. We work with the accountants. A quantity surveyor is someone who measures and estimates the construction costs of buildings. So I did a building degree, come out, know how to count bricks from plans, and work out how much concrete is in a building, how much steel, how much carpet, how much of everything is in there, and then we'll estimate how much it would cost to build it. The tax office, like someone who knows about construction costs, involved in the depreciation claims because they do relate to the cost of construction and the value of items in there. So we come in, we can estimate the construction cost, and they'll be accepted by their tax office. So there's a thing about compliance with the tax office rules, making sure that we know how to cost it. Valuers, real estate agents, accountants, they don't cost up properties. Quantity surveyors do. We measure, that's what our normal expertise is. We need to put that along with how do we maximize those deductions by knowing how to cost it for compliance, and also knowing how to treat things the right way for the purpose of depreciation to get the most dollars out of it. Now, what I'm going to do first is go through and say, what difference does it make? Why do we claim depreciation? And let's run some numbers. All of the investors that you either sell property to or manage property for here, buying properties, there's some numbers and it makes a big difference to those. Let's run a simple scenario and see what difference it actually does make in cash if we actually buy, if we actually make sure we do depreciation properly. Let's take a simple new 4-bedroom house purchased for $820,000. We get some rent for that property. Let's say that's about $700 a week. So the income for the year is $36,400, which is great. We've got some money. Then we've got some expenses. Interest, which seems to continually go up of late, and it's got a bit more expensive, obviously. Interest, rates, management fees, all those expenses in order for an investor to hold on to this property of about $50,200 a year for a property of that sort of purchase price. We've made some assumptions there. So that's going to cost them about $13,800 a year. or $265 a week in order to hang on to this particular investment property. Now, it does get a bit better than that. When we make a loss, like we have on this property, then the tax office allows us to, or the government allows us to make a deduction for those losses against our other income. So someone who's got this property, kicking in that $260 a week, makes a deduction of that amount at the end of the year, a deduction of $13,800 if they're on a 37% marginal tax rate, which is where most property investors sit in this country. They're going to get a tax refund of $5,106 of that $13,800 at the end of the year. Then it's going to cost them $8,694 or about $167 a week to own that property. So that's a bit better. It's not $265, it's $167 a week. Now this assumes we don't claim any depreciation. It's the costs out, make a deduction, get that back from the tax office. If we claim depreciation, the scenario gets a bit better. The depreciation claim on a new property of that sort of value is about, we would see it about $16,500. The difference between these two deductions, the $13,800 you pay out, the $16,500 is properties wearing out, getting older, wearing out over time, and we claim a non-cash tax deduction for that. Our total deduction now is $30,300 at the end of the financial year, meaning our refund is now $11,211. So the cost now to own this property comes back to $2,500 a year, or about $49 per week. So the only difference on these two sides of the page is that on the right-hand side, or the second column, we're making sure we maximize those deductions, claim those deductions, get that amount, and the difference in the cost of holding this property is $117 per week. My job on this whole page is pretty simple. That $16,500 number, we need to make it as high as we obviously legitimately can. We need to make sure we cover the risk of doing the right thing from a tax office point of view. We come up with those numbers. That's what we've done, 900 and something thousand times for property investors to make sure we maximize that number. The accountant obviously does the rest of these numbers on the page. That's the difference it can make. Fairly powerful amount of difference, and it makes a big difference to the cost of whether or not you can buy more properties or you cannot buy more properties as a property investor because of the difference in the cash flow. Now, I won't go through scenario number 2 in as much detail. These scenarios, you can run your own ones on an app that I'll explain a little bit later, but I've just pulled up a secondhand property. One of the things that I hear on a highly regular basis in my daily travels, I guess, is that people think depreciation isn't available to secondhand properties. It is, it's not as much, and there's a few rules that have changed over years that have changed how much it is, but I would say forget secondhand gets no deductions. Some secondhand property gets more than others, some doesn't get any. But how about you ask us? We'll talk to you about those properties. We'll see if there's some numbers in here. Let's take this scenario here. Secondhand 4-bedroom in house, built in 1993, purchased in 2023, $750, $620 a week, costing $275 a week to keep it to start with. Once we make that deduction for that loss, we get, it comes back to $174 a week, as we can see on the first column. Once we make depreciation, it's $7,800. It's not $16,500 like the new property, because it's a bit older. And the reason is that things are older, things have got, things didn't cost as much to build back then when it was built, etc. But we come up with these numbers, make them as much as we can. The difference of claiming depreciation on this or not is $56 a week, or nearly $3,000 a year. So does still make a substantial difference. If you're in property management, that's probably more, that $56 a week, than you charge for your services. So how do you sort of connect yourself to asking this question about the older property? There's still deductions there. Why don't we ask the quantity surveyor and see if you can get anything from it, basically. Now, we'll get some bit of technical on how it works here, not too much. You just need to know a little bit about it, but more importantly, keep it simple when you do talk to clients. If it's old, there might be still deductions. Let's talk to the quantity surveyor. So you've got a bit of an idea. The claims are broken up into two areas. One is what's called the capital works, or Division 43 allowance, and this is a portion of the construction cost each year. How this one works, 4-bedroom house built in 2013, if it costs $300,000 to build back then, it gets a $7,500 deduction each year against the structure of the building. The capital works is concrete walls, floors and roofs, things that last a long time. So in order to claim this, it needs to be built after 1987 if it's a residential property. So in that case, the age does kind of matter, but I always want you to think, don't worry about age, let's ask the county surveyor, see if there's any dollars there. But this one, if it's built after 1987, this portion obviously gets some fairly substantial deductions because it's related to the construction cost. This also relates to renovations. If someone's bought a house that was built in the 50s, doesn't get it on the original bricks and mortar, but you do get deductions if someone's done a renovation 10 or 15 years ago, spent a couple $100,000, then even as a buyer now or an owner now, you can claim deductions against that, regardless of whether you did it or whether someone else did it as the current owner of the property. The other component that we get to claim, plant and equipment, Division 40 items, things that last not as long. They are claimed based on what's called an effective life. We'll talk about effective life in a moment. I've got a cool tool that you as property managers or mainly the property managers, not the sales people, will use in regards to effective life. And they work out a rate based on that and claim them. You can see things here, 25% of a dishwasher is claimable in the first year, and it diminishes over time. That's a much higher rate, obviously, than 2.5% against the building. So the more of these things we can find, the better. But there are some rules that have changed in the last few years that these things need to be new to claim them. So the new properties do get more because they get to claim these things, or if people put new things in, there's more deductions based on those. Kind of covered most of this in the last slide, but these the changes that came up, and it was 2017, which is quite a few years ago now, but we still get a fair few questions. So I'd just like to say that secondhand property gets deductions. The one thing that doesn't is secondhand plant and equipment. Commercial properties still get it on secondhand plant and equipment, but residential properties don't. Secondhand assets added by the owner do get deductions. New residential property do get deductions against all these things. But we look at the property, work out what's been done, work out who's done it and when it's been done roughly, and work out what can be claimed. Now, if you're ever concerned, or your client's concerned about whether there will be enough deductions in a property that isn't new, new ones are pretty easy. Old ones, we've got to just make sure it's worth it. So we'll talk to the people about what sort of deductions are there. We'll make sure it's worth it before we go ahead and they incur costs. And if we are wrong after that, even if we've started the job and been to the site, we'll still cancel it and give them a double our fee and deductions in the first financial year, or there's no charge. So if we can't find some deductions after we've asked a few questions, we go out and half do the job and realise we can't, we call them, we give them their money back, and we move on with our day. They're not going to get deductions. It's not worth me doing finishing depreciation schedule and making them unhappy. Now, just touch on what sort of deductions we get out of some new and second-hand properties and how many of each we do. This is in the 22-23 financial year, and based on the 40-something thousand depreciation schedules that we did in that year. The overall average across the board for the year in the residential properties is just under $9,000 in the first full financial year. So quite substantial as an average. You know, obviously we've seen the new one that got 16,000. There's a lot that get 8,000, 5,000 and whatever else. And we can see from these numbers that brand new properties, we can see about 28% of the jobs that we do are in that year were brand new. Fairly new, 16 to 19, 16% of them. We can see $15,000 for the new ones at the bottom of the table is the first year average. Then the fairly new ones, it drops down to a bit over half of that. Then we can see through those other years. Interesting, a lot of people obviously are buying properties that are aged between 2003 and 2015. It's nearly as much as the new ones in that age group. So quite substantial. And the one at the top is I don't know, so not necessarily surprising because it always comes out this way, but it does demonstrate that properties built before that building allowance date in 1987, it is 14.5% of the jobs that we actually do, and the average first year deductions just over $5,000. So still, a lot of these would have been renovated over time. Still, $5,000 in deductions in the first year is quite substantial, and does mean that they get some dollars out of older properties. So second-hand properties that can't claim on previous year's plant still claim an average of $6,348 that have been after that date we talked about. So some numbers on percentages of what we did do last year and what sort of deductions they got on average. Renovations. Let's just touch on renovations. We, based on our data over 100,000 schedules that we looked at, about 66% of them had some sort of form of renovation by obviously either the current or previous owner. So renovations obviously is a thing that investors obviously do, or someone that owned the property before them did that. We like to go to site, make sure we get these renovations, find them, get in and find every deduction we can out of them, because 2/3 of the properties that we did do over a couple of year period have had some sort of renovations. When you're renovating, there's a couple of things to consider. Before you let the owner rip it apart, we need to think about scrapping. And the thing you need to do there is make sure you call the quantity surveyor first, unless you already have a depreciation schedule. What scrapping is when we do renovations and we throw things away that may have had some depreciable value left, rather than continuing to deduct them over time, the investor's able to potentially write them off all in that year. Whatever value is left, potentially can write off straight away in that year and claim it at 100%, which makes a pretty substantial difference in that year of the renovation, which is great because they get some more money back in that tax when they've spent all this money renovating. So the important thing is call the quantity surveyor before you rip it apart in case there is some dollars there. A good example of that is, often these days you probably see a 30-year-old kitchen starting to get renovated. A kitchen itself actually has a life like the rest of the building of 40 years. You've still got 10 years or a quarter of it left. It can be a substantial deduction in that year that it is thrown away. Obviously, after you renovate, you put more things in there, you make more things to, you bought more things to depreciate. So you need to update those schedules after you've had a renovation done. Commercial property, the regular question, do you do commercial properties? Absolutely, have done forever. All types of things, warehouse, retail, office, restaurants, cafes. My name is beer, hotels and pubs, so we should be good at those, I suppose. Farms is something that we've done a lot of, especially in the last couple of years. There seems to be a lot of transactions in farms. They've also changed a lot of the rules around primary production in depreciation and claims, a lot of instant write-offs and things. So they've become, I guess, a bit more complex firstly, but there's also quite substantial deductions out of some of those. Industrial unit here, sort of, first year on 800 square meter property, $30,000, 130 over 5 years, or 1.2 over the total 40-year life. Commercial, industrial, all those types of properties, similar rules, some are slightly different, especially the plant and equipment one. Substantial deductions available to people that own commercial properties. Frequently asked questions. The most frequently asked question I think I hear about is probably the one around the accountant. Doesn't my accountant look after that? And when you do talk to the clients about depreciation, they'll go, I've got a good accountant, or doesn't my accountant look after that? Is something that we work alongside the accountant. Remember, we're the cost guy, we make it compliant, and we also visit the site, find everything and get the most deductions out of it. The accountant doesn't go to the house. We go to the house and we'll be accepted by the tax office. Most of the work we do is actually referred by accountants. People listen to their accountant, they think they've got a great accountant, and they probably do, and a good accountant will make sure they've got a quantity surveyor to help them to maximise that deduction and minimise the risk should there be an audit. Is the property too old? I've harped on this a bit, as I always probably do, because people still seem to have an idea that old property doesn't get deductions. We've seen that properties built before 1987 that we did last year with 14% of what we did do, and they got an average in the first year of $5,000. Many people at the pub would tell you that an old property doesn't get it. It's not true. Ring the quantity surveyor. If I tell you there's nothing there, there's nothing there. Otherwise, there's potentially some deductions there. You want to see if you can get some money. Furniture. If you buy furniture and put it in your investment property, it does need to be new furniture. It's claimable. We include it, and it gets more deductions. Is it too late to claim back in the past? Important question, because you come today, or your clients that you may manage property for or be selling property to might have other properties or properties you're managing. They can go back and amend pretty easily up to 2 years of their tax return. So if you don't pay your tax, the tax office will find you eventually and they will come and get the money, maybe give you a fine as well. If you don't make your deductions like you can as a property investor or anyone, then you can go back to the tax office and say, last year I should have claimed some deductions and I didn't. For 2 years pretty easily, you can go back, amend your deductions, and we've seen some people get some substantial money by going back and amending some previous years and getting as much as we can out of that. So the thing to think about there, especially if you're a property manager, is there's a lot of people in your rent roll that think it's too old or don't know. What you need to really do is get to them and go, can we help you get some money? We can give you estimates. I'll give you some tools on how to ask those questions later, but they all need to be pretty simple. Why is it important? They get more money. People with more money, because their property manager is the smart one, probably talk about that situation. They think their accountant is great, but you know them as well. Maybe you've got to ask some of those questions and hopefully you can stand out from the others. Simple little things that you can do. Impress them with the calls that you make sometimes for no great reason, I guess. Positive phone call. You don't really need to be the expert on depreciation. I've given you a lot of information there today, but really your conversation with the landlord is, I want to make it work as hard as possible. Depreciation is something that I know is on old properties. A lot of people aren't doing it properly, getting as much as they can get. I want to make sure that we are getting as much as we can out of this property for you, and you can handball it then to the experts to talk about their property to see if there is some deductions there. So we can at any time give you an estimate of what sort of deductions might be available should you want to talk to a client about that. I've got some tools and sort of ways you can do that coming up, but keep it simple. The question around, does it need to be new? You know how to answer that now. Old property still gets some depreciation deductions. It doesn't get as many, but why don't we see if the quantity surveyor can find some? Doesn't my accountant look after that? The quantity surveyor works alongside the accountant to help maximize this deduction and get as much as they can out of it with your accountant. Really got to keep those things really simple. Depreciation estimates. So any time that you might want to get an idea of what sort of deductions the investor might get, we've got sort of 3 different ways to do that. First one, which is the quite simple one, is as you list properties for rent, we have something called new to rent. Go join it, it's free, and every time a listing comes up, we get the data. If there's enough data around about that property, our algorithms will actually develop from the data we get from the data people on what sort of deduction might be available to that particular property, and spit it to you in an email that looks like this thing on the right here that says your property at whatever street should get between 6,000 and 8,000. It's actually bespoke or it actually relates to the particular property that we've seen listed, when it can automatically find enough data to do that. Set, forget, twice a week, every week you'll get estimates of emails with estimates to forward to clients that you've just put their property for rent if there's enough data available. Very simple, very easy, and could be something you don't have to do much. Join up, send it each week when it comes out, basically. The other way, another way is to register inside My BMT. These estimates that you do get automatically will be in there, and you can also enter other addresses and get some of these estimates as well. They're in there. You can see you download them as a PDF or just forward them onto your clients very simply. You can just enter an address in here of something and get some type of estimate that you can send to an existing landlord that's not one that's just been listed. I don't know all of your properties in your rent roll, obviously, but this is a way where, someone that you think you'd like to call, you can enter and get an estimate of what sort of deductions might be available. They all sit inside under one login under My BMT, which is also the portal which the clients use to see their depreciation schedules. It's got some other cool stuff in there for the clients as well. But for you as property professionals, seeing those estimates or being able to get those estimates on properties can be done that way. So new to rent would be inside My BMT, as we just discussed. Inside there also what the landlords can do, or the property investors, they can track their income and expenses. So they enter them and share it with their accountant. They can share their depreciation schedules with their accountant, or we share it with the accountant actually. Their accountants can see, an accountant can see all of their clients' depreciation schedules inside this portal. It's also got PropCalc, which is a tool that you can use as an investor to calculate the cash flow like we did in those scenarios at the start on any property. You enter the own information, your own tax rates, and it will spit out a depreciation estimate and give some idea of what the holding cost should be based on the information put in. Market data, so planning alerts, planning applications that are, if I'm an investor and I've bought a BMT schedule on my property inside my BMT, we get the planning application. So if someone's going to build a 20-story high-rise next to my investment property, this will actually spit an alert as an investor to you to say that that's going to happen, and you can see what's going on around your properties. Automatic valuations that are done by the guys that do them for the banks. So AVMs, they're called. There is some AVMs available to investors on their within a radius of their property. Depreciation rates at your fingertips. We talked about the effective life of items. This particular app for a property manager is very handy and well used. There's a list of assets that we can claim depreciation against in a property. Those assets are obviously in the property. When you go to tribunal to argue what the life of these things and who should pay in the event of someone damaging the carpet or whatever it is, the tenant, the tax office, sorry, the tribunals will use what's called the effective life, which is the same effective life that we use to calculate the depreciation. So the tax office puts out these effective lives on things, and we can see all of the items there, or some of the items there. There's about 160 items in a residential property that they put a effective life on. We can see that carpet, for example, has a life of 8 years. When you need to go to the tribunal and put a case forward for the landlord with the tenant on who needs to pay for carpet that's 4 years old, that's been damaged by the tenant, they will use that 8-year effective life. If it's 4 years old, they say 4 years is gone, 4 years is left. I assume they come and say half each, basically. The tenant doesn't have to pay for all the new carpet, but neither does the landlord. So these effective lives are inside the app that you can go and see. Resi rates, it's free, and there's also a one-page that you can download from there, or we can send to you if you respond to the email that gives a list of the main items, so you've got them in front of you should you need to use that. Well used by property managers, gives you all the effective life, and we've got some units and measurements there, some measurements and approximate rates across some of these things, so you get a bit of an idea of what the cost may be. You can print them, use them. There's also another app called Rate Finder, which actually puts out, I forgot the name of that for a second, puts out the list of all of the items across outside of residential properties, which are available, which have an effective life, which was everything in the commercial space, or everything down to your photocopier and whatever has an effective life. You'll be dealing mostly with these few items that we've put on the PDF, but there is the resi rates if you need more of those. Sales agents, how do you sell more property? Depreciation, we see on new properties the most. Second-hand property still gets it. An estimate of what sort of deductions might be available to a potential investor. If you're going to sell a property and it may go to an investor, an idea of what depreciation might be there would be handy. It could help them if they're crunching their own numbers to go, how much will it cost me to own this property? And they are free. You can get them from us. You can use the app to get them, the depreciation calculator app, or we can give them to you in this sort of format as well that gives an idea of what sort of deductions might actually be available. Use them. They're free. Give them to their potential investors. If the person's crunching their numbers, which they should be, they might be more likely to buy it if they think the cash flow is going to be a bit better than otherwise. If you're selling new projects, we often produce these. We call these a phase A, off the plan estimates that lots of developers or guys project marketing use to show the first 10 years of approximate deductions, maximum, minimum. We produce these, they're free once again. Obviously, we'd like to do some depreciation schedules for the buyers in the end, but these things can be produced if you're selling properties. Prop calc, mentioned that quickly. You can see what it looks like there. What it does is it helps someone to calculate the true after tax of holding a property. So if they're looking to buy something and using prop calc, they can get an idea, some research and insights around that. They can save and compare different properties they're looking at, but it's free, it's an app, and can be downloaded or found obviously also in my BMT. A few other apps, I've probably touched on most of them. Rate Finder, Resi Rates we talked about. There's a construction cost calculator app. Once again, heavily used, people looking to build something. Over the last few years, construction costs have increased quite substantially, so we do keep that up to date. Well used app there. Prop calc we talked about. Rep cost is a replacement cost estimate calculator for insurance. So when someone wants to insure their house, they need to come up with a number to insure it for. The insurance companies don't really help a whole lot with that, but they do need some sort of number to put there. That's a way you can actually come up with that number and some information about your house. For us, BMT difference, found nearly $9,000 average in deductions in the first year. Double the fare, it's no charge guarantee. We make sure they're compliant. We do them all over Australia. We inspect all the properties. One thing we do, I've always done and still do in COVID, some of our industry has decided they'd like to do it off the photos because it's easier, and it is easier, but you don't get everything. 2/3 of the time they've had renovations. The Institute of Quantity Surveyors would like the quantity surveyors to inspect them. They think that's the way to do the job right. So do we. So we inspect, it costs a little bit more time, but I've got nearly 200 staff. They're spread all over the country. We use our own staff for those. We don't contract out that process. We will pick up keys from you where we need to. On the Institute of Quantity Surveyors, or the Australian Institute of Quantity Surveyors, the industry went through a bit of a, I guess, let's try to get all the quantity surveyors to do it right when they're doing depreciation schedules, because there's lots of traditional quantity surveyors that often don't do the other piece of the tax rules properly. And they did point out some things around referral fees. There must be disclosure to the client. We don't pay referral fees because the RQS doesn't believe it's morally justified in our industry. Firstly, we also think, based on the $700 we charge, that we want to get the job done properly, make that clear to the client that there's no, I guess, kickback or referral fee. They want the best guy to do the job, or girl. Site inspection should be done to capture everything, maximise the claims, make sure that if they do get an audit, it's done properly. Simple, talk to us. We see if there's going to be something there. When do we do that? We might talk about before, we might do it when it's settled, when it's tax time, or remember when it's renovations, call a quantity surveyor first. We get some information, we go out, we visit that site, make sure we find everything, come back, produce that report, and we produce that report. We have had some time challenges over the last little while in getting those done. Last year wasn't great for, I guess, having the resources, which some of you would have experienced. We're back on top of them, we're back to normal turnaround times, and we're ready to push them out in those shorter periods of time. We've concentrated on make sure we get them done properly over that time, make sure through COVID that we inspected the properties, we held them up and did them. It gave us some challenges around the timing for getting these reports done, but these, through the quieter period, we've got right on top of that and got the resources this year to get them done properly, get them done in a more timely manner. Thank you today. Hope you guys learned heaps from that, and go use the simple things to help with your clients to get them some money, get them some more depreciation, and maximise those returns on those investments. Thank you very much.